Here we are for another episode of the Wealth Renegade podcast. We are going to talk about overpaying. Both of us are pretty frugal, almost down to the point of being misers. I was actually just at the mall yesterday trying to be convinced to buy another pair of shoes, but I will only wear things that are free. So we have had experience with overpaying for deals in our minds. Maybe someone would look at it and think otherwise. Everybody's got their own ideas about investing. What do you call it? Opinion salad.
Oh, yeah.
That they can throw at you. So we're going to dive into a little bit of Blackstone, which is one of the biggest institutional investors in real estate, and a little bit of our own experience. What do you think about diving into your experience?
So the overpaying opportunity where, okay, you can get this thing that you might want, but is it worth the premium you're going to pay for it, is always tempting. I think so many people try and make that okay to themselves. They find their comfort level with overpaying. And actually, my dad once said that he thinks he's overpaid for every house he's ever lived in. And yet, it always turns out okay because the next person also overpays.
What does he learn from it? Or what has he? I mean, what is he giving to you? Or is he just saying, I think I've just overpaid?
I think he's making it okay in a way. And that's probably the hard part, is at what point, what constitutes overpaying? What actually is the point where it becomes a problem? What is the point where it becomes the difference between a financial success and a financial failure? And I think that's what we're going to talk about, because it is not simply a binary code. Because you underpaid, you won, and you overpaid, you lose. There's so many factors that play into it. However, there's probably some principles that we'd want to outline for it. And when you're thinking independently as a wealth strategist, as someone who's working on their own financial future, you've got to weigh these things for yourself, because your 401k doesn't give you a choice. You buy your mutual fund at the price that it's at on the first of every month when you make your contribution. You might overpay your entire life and you would never know it. So when you're going to consider deals in more specific fashion, when you're going to take charge of your own deal making, these are questions you have to consider. You asked for my experience. I didn't say anything. Let's go to you, and then we'll share.
Well, I kind of want to pop in on that and say that even if you do overpay, there are ways to get out of it. And that kind of segues into what we're doing, but kind of in line with the wealth renegade side of things. It's not binary, like you're saying. There's not just overpaying. You might be able to pay a little bit more if you employ another strategy. So with what I did, I guess kind of on my house, I think that I overpaid for that thing. I mean, it had termites in just about every board in that house. It had black mold in almost the entire basement. It had dead squirrels in between the studs, and it needed a completely new roof because the squirrels had literally eaten holes in the roof to get into the house. So I paid probably, in my estimation, at least $50,000 over asking, and it was a $187,000 purchase price. So $50,000 isn't like it's not small change for that kind of deal. So looking back on it, what do? I mean, it's in the rearview mirror. The lessons are learned, but going forward, and that's kind of what I was getting at with your dad. It's like from an investment standpoint, like you have to learn, you have to get better, and you have to grow and change your model and adapt to what's coming next. And it would have been interesting he'd have an answer for that, no doubt. Like, yeah, I would implement this or talk to this person or gyp them down a little bit. But for me, in terms of my house, I would just have to go through with a completely different mindset. And a lot of times where I get caught is thinking everyone is out to maybe not help you, but at least be kind and reasonable. But I mean, the business place is filled with sharks, right? So you have to know what you're doing when you're out there spending your money. It's not that you're going to sink your ship if you don't know absolutely every piece of the puzzle, but that's where you really start to make it over the other investors and people coming into the space, is when you really tighten that down and hone your model.
And learn the lessons the first time rather than continually repeating the same story over and over and over without ever taking any lessons from it. That's what's the definition of insanity? Doing the same thing over and over and over and expecting different results. I mean, that's the 401k world in a small way, is you're just going to keep funneling money in, and you're expecting at some point suddenly you turn into the robber baron of the north or whatever. You turn into some ultimate successful person, but there was no differentiation. You did the same thing over and over. There was no gearing up, no growth occurring for yourself along the way. A famous real estate investor named Ken McElroy down in Arizona, owns properties all over the United States, 10,000 units, talks about how he identifies the price he's willing to pay. He's good enough at what he does that he lays out the entire financial model and goes, this is the price that it works for me. It's not a personal thing. It's not me trying to, to sneak that house away from you or steal it out from under you because I'm the only offer you get. Oh, this will be the best offer, therefore you should take it. He's not doing that at all. He goes, for me as a buyer, this is the price it's willing. This is the price where I can make it work. So this is the price I'm willing to pay. If you don't want it, fine, walk away. But I like that approach because it depersonalizes it. I, at one point in one of the investment properties that we partnered on, was strongly suggesting paying $206,000 for the property, which unfortunately, that number came
throw that in there
from Zillow. It's actually what the sellers presented to us as an option, but we had just paid $180,000 for the property next door. Basically a carbon copy. There were small details that the sellers thought were magnificent to present to us, and they said it's worth $26,000 more, but at the end of the day, it was $26,000 more, or roughly 10% more for the same thing. And I was the one saying, it's worth it. The financials lay out, we can make it in the long run. We want the deal more than we don't want it. And that was my...
what? I mean, to kind of be fair to you, what were the influencing factors behind why you were pushing to do that?
I felt like the property was poorly managed, the rents were under market, and there was opportunity on the upside that when you take a long-term debt approach and you're paying off that overpayment by, $26,000, but you're paying for that overpayment over 30 years, I felt like we'll absolutely hop over that curb. It will be no problem. That does not mean that there's not a smarter way of doing it, but I was totally committed and I was pushing our whole team to say, it's worth the price. It's worth the price. And in hindsight, what would we have done? It's a fair question, but I do know that we would never have gotten the same. We would have overpaid, but we also never would have gotten the same construction loan opportunity. We were offered a construction loan that has a certain percentage margin, and we would have had half our construction budget if we'd overpaid. So the story itself is fascinating, and in another episode we'll get into it, but there was me going, let's overpay, because I think the financial picture makes it work.
We've got a nice mix between us where you are always thinking long-term with how money grows and inflation impacts, and I'm sitting there like, it is a zestimate. We cannot pay for a zestimate. And then it ended up working out in our favor that we fell out of contract because we could not secure financing. Probably one of the reasons, it probably impacted that people, underwriters that know what they're doing with these numbers, looked at that and were like, $206,000? That is top tier, and you guys want to spend more money, like bringing it up to snuff? There's nothing to be made here. So they looked at it, and then we fell out of contract, and it happened okay. The worst thing happened. We constantly touch on that like the thing nobody wants to happen, the contract falls through. And then it worked out even better because they took off how much of the price?
They took off the full $26,000 and matched the previous price we paid on the next building because they had to sell. Their situation changed, and at the same time, Zillow was suddenly starting to sell off all its houses because they were worried about their financial picture, and people were ripping on Zillow for raising the zestimates falsely. And we do have a little theory that those sellers were leaning on Zillow as this tried and true, trustworthy home valuation partner. And
they were telling us blatantly. They're like, Zillow says it's worth blah, blah, blah. And I'm pulling out my hair like, who cares what Zillow thinks?
Yeah.
And then it was funny timing that all that stuff came out in the news with the Zestimate and Zillow, and then all of a sudden they changed their tune. So we don't know what happened on that side of things, but just kind of interesting coincidence.
Yeah.
So we learned the lesson of overpaying from who came to us and was starting sort of underwrote the deal on a napkin and said, no, too much.
We went to a private lender trying to close at the last possible second with a different financing structure in place using the private lender. He said, never overpay for anything. Therefore, we were in a little bit of a sticking point because we wanted to go forward to close. We didn't want to give up the deal we felt we had prepared so well for and had opportunity to capitalize on. And yet he was telling us, you are overpaying and you never overpay for anything. He was saying essentially, your whole portfolio is not improved if you overpay once. And that's fascinating because on the other side, we just saw in the news a couple of weeks ago, Blackstone paid a premium price for premier apartments 37% over its publicly traded share price value because Blackstone wanted them so much. They own about 12,000 units all through Sunbelt states, and Blackstone was willing to overpay on the entire picture. And it's a fascinating way to look at things because here you have the biggest real estate investment trust in the world, capturing the most real estate across the most markets internationally, and they're willing to overpay for their apartments. So it lays out a fascinating piece. And I would say Blackstone probably knew something that everyone else did not know. They beat out everyone else to buy these apartment complexes that this conglomerate owned, and that's a big deal.
I think it's a fascinating concept, but where we maybe sort of differ is I think it's an indicator and a good insight into the market, what the big boys are doing. But they are big boys. I mean, buying out a 12, what does it take to be an institutional investor for multifamily?
It takes 10,000 units. That's where
10,000 units, and Premier had what, 12,000?
They had 12,000. They'd been around for 40 years, I think. So they'd been doing it a long time. I think at one point they actually had more like 20,000. So they had sold off a little bit of their portfolio along the way.
Right, and weaned into the best of the best of the best. I mean, the premier units. So I look at it, and to me, it's a good indicator, but they have such big force in the market that they almost are the market. It's like when Apple comes out with a product, everybody copies Apple. Like, I see the resemblance between like Ford pickups and Nissan just about every year. It's like whatever Ford does, you bet Nissan's coming out with it a few years later. And it's just following. So everybody, like Blackstone, they have the resources. And I heard on a different podcast, I don't know if we can say it, but BP podcast, they said that in 2008, Blackstone actually had influence on raising us out of that recession because they inserted and injected so much financial capital into the market buying those single family homes for rock bottom prices because they knew it was going to come back, and that was just a great time to buy. So seeing what they're doing with Premier and overpaying, I think that there are certain situations, and they obviously know what they're doing and they see the other side of the picture because they are so good at what they've done and they've done it for so long that they can see down the road for that sort of thing. But for us at our level, how does that impact for you? I mean, what do you take it as gospel that Curtis told us now? Never overpay. Don't overpay. I mean, we had a conversation the other day. It's like, who do you want to model yourself after? I mean, Steven Schwarzman I would much rather be Steven Schwarzman than Curtis whatever, but at the same time, how did Steven Schwarzman get to be Steven Schwarzman?
Yeah. And the other thing, to pause on your question for a second, to consider is all the way through, you're having to make deals and you're having to make decisions about what cut of the pie are you taking, what are your subcontractors taking, et cetera, et cetera, et cetera. And we were just reading as well about a St. Louis developer who's obviously very good at parceling out his portion of the pie no matter what happens to anyone else. And so you can get trapped in looking at it from a personal standpoint. Like, if I overpay, I give them too good of a deal. Or if I can get the price I want, I scalp them. That's where I do like that Ken McElroy concept. It takes it to a principle. It says, this is the price that makes the deal work. It's not about you. It's not about me. It's about the deal. That's probably my best touchstone in terms of principles for overpaying is, at what point does your model, your business model, your vision, your ideals work in the property? And then you need to stress test that. That's where that actually has to take a deeper step. You have to go, okay, well, what happens if vacancies hit for me? What happens if the rates fall and suddenly mortgage rates go up? Or if I'm buying a 5-year ARM mortgage, an adjustable rate mortgage, and it adjusts way up in 1 year, are you still okay? Does the deal still work? So the more sophisticated you get, you begin to be able to look into those stress tests, into those doors that come and go, and be able to figure out, how can I make this the best deal for me? And then you simply put that offer out there. You listen to a podcast a lot where the gentleman puts it out there, and tell us a little bit about that story. He puts that offer out there, but there are others out there, and yet people keep coming back to him for a reason.
He gives a price, and to add to that, he never competes with other people. Once he finds out that there are other investors coming and the buyer or the seller is shopping around, he goes out of it, because he's not willing to compete, because he might be a little bit higher than that competition, but he knows that what he's offering is so solid and so sound, and he delivers every single time, that's what people are paying for. And that costs him. I mean, it costs effort, it costs time, and it has cost years. I saw a funny little TikTok. It's like, you're not paying me for the 30 minutes that it takes me to change out that door, because it'd take you 10 hours. You're paying me for the years of experience that I've got that go into honing that craft and bringing it back down to half an hour. It seems expensive to you, but it was really expensive for me to learn how to do that. So for him to be, and there are people that are in business doing things all the time, but they're not good at it. So you're paying for quality. It's just like anything else. You pay for what you get.
What's the triangle? You got time, speed, is it quality is the third leg, and you can have two, but you can't have the third one. And so you can have time and speed, but you're going to lose quality. No, it's price, speed, and quality. That's what it is. And yet you can have price and speed, but you're going to lose quality. So then you can have price and quality, but you're going to lose speed. So there's opportunities in every standpoint in the market, whether you're at the top of the real estate market, like some people think we are right now, or you're at the absolute bottom. The absolute bottom is an obvious one, but that's often where everyone's losing their shirts and selling the things they have. The trick to being an investor is being able to do your own thinking, draw the conclusions, and take the trajectory outward and go, is this where I want to be? Can you skate to where the puck is? It's hard to do, but that's what makes all financial opportunities worth it.
I like that undertone that Ken McElroy has. I forgot about that. It's taking yourself out of the deal, analyzing your goals, assessing what needs to happen, and then putting the offer out, because everybody's got different goals.
Yeah.
That's what the Wealth Renegade is about. It's just identifying your goals and finding a different way to get there than the 401k.
And they just might sell it to you anyways. Thanks for listening.